Hello, my dear friends. Today, we're diving into the fascinating world of income from house property under the Income Tax Act, 1961. When we talk about income from house property, we're referring to the revenue one earns through their real estate investments, which could range from residential houses to commercial buildings. This category of income isn't just crucial for individual homeowners, but is equally significant for tax professionals who navigate these waters to optimize tax liabilities. Understanding how income from house property is taxed can help in planning one's finances more effectively. It plays a pivotal role in determining the annual tax returns of individuals. From rental income to the potential deductions you can claim, this income type has various facets that affect your financial health. This exploration isn't merely about numbers. It's about understanding a key provision of the tax code that impacts a broad spectrum of the population, from the single property landlords to the real estate moguls. So, gear up as we decode the essentials of this income category. First off, what exactly do we mean by income from house property? This term might sound a bit complex, but it's actually quite straightforward once you break it down. Under the Income Tax Act of 1961, income from house property refers to the revenue that an individual earns from a property that they own. This property can be of various types, such as a residential house, a commercial building, an office space, or even a warehouse. Essentially, if you own a property and it generates income for you, that income is what is considered as income from house property. Now, let's delve a little deeper. The income from the property typically comes from renting it out to tenants. Whether it's a family renting your residential property for living, a business using your commercial space for operations, or a retailer leasing a warehouse for storage, the rent they pay you contributes to your income from house property. It's important to note that this category of income is not about the occasional income from selling property. That falls under a different category called capital gains. Income from house property is strictly the income that accrues from renting out the property or even from letting it lie vacant if it has the potential to be rented out. Moreover, the ownership of the property plays a crucial role here. You must be the legal owner of the property to declare its income under this category. And, interestingly, it doesn't matter whether you're the sole owner or a co-owner. If you co-own a property, you can still declare your share of the income from the property under this head. Furthermore, even if you have inherited a property and are now earning rental income from it, this income will be taxed under income from house property. The same goes for properties that have been transferred to you under a trust for which you are the trustee. With this definition in mind, let's explore what qualifies as income from such properties. Not all income from property falls under the taxable category. Let's find out what does. When it comes to income from house property, several conditions determine its taxability under the Income Tax Act of 1961. The first and perhaps the most fundamental condition is ownership. The income from a property is taxable only if you are the recognized owner of the property. Ownership extends beyond mere possession. It includes having title and control over the property. Next, let's consider the type of property. The property must be a building or land appurtenant thereto. This could be a house, office building, warehouse, or even vacant land attached to these structures. Importantly, the tax applies whether the property is used for residential, commercial, or any other purpose. Another critical factor is the actual or potential rental income. For a property to attract tax under this head, it should generate income. If the property is let out, the actual rent received is considered. However, in cases where the property is not let out, the potential income it could generate, often termed as annual value, becomes relevant. This value is not arbitrary, but is calculated based on specific rules that consider the rent fetched by similar properties in the same or similar locality. Furthermore, the property must be available for renting out. If a property is used for personal purposes throughout the year, its income is not taxable under this category. Understanding these conditions helps in accurately determining your taxable income. Now, Knowing what you need to pay is one thing, but what about what you don't? Let's dive into the world of exemptions and deductions under the Income Tax Act for income from house property, which can indeed lighten your tax burden substantially. First up is the standard deduction. It's quite straightforward. The Act allows a deduction of 30% on the net annual value of the property. This is provided irrespective of the actual expenditure on the property. So, whether you spend more or less on maintaining the property, 30% is what you can deduct, no receipts required. Moving on, let's talk about the interest on borrowed capital. If you've taken a loan for the purchase, construction, repair, renewal, or reconstruction of the property, the interest payable on that loan is deductible. This can be a significant amount, especially in the early years of a loan, where the interest component of the EMI tends to be higher. It's important to note that if the property is self-occupied, there's a cap to this deduction, which changes based on prevailing financial regulations. Additionally, homeowners can deduct municipal taxes paid during the year from the gross annual value of the property. However, these taxes must be borne by the property owner and paid during the year to qualify for this deduction. Now let's consider a scenario. Imagine you own a property that you've rented out. The gross annual value of this property, let's say, is determined to be 50,000 rupees after considering the rent received and other relevant factors. If municipal taxes paid by you amount to 5,000 rupees, the net annual value comes down to 45,000 rupees. Now, apply the standard deduction of 30% and you can reduce this amount by 13,500 rupees. Subtract any interest paid on property loans, and you'll see how these deductions can significantly lower your taxable income from this property. Applying these deductions correctly can significantly reduce your tax liability. So it's not just about how much you earn, but also about how much you can smartly save on taxes. Let's put theory into practice and calculate the income from house property. To navigate through this, we'll use a straightforward example. Imagine you own a rental property. The first step in this journey is to determine the gross annual value, GAV, of the property. The gross annual value is essentially the highest value between the actual rent received and the expected rent of the property, which is its fair market value rent. Let's say the expected rent for your property is 10,000 rupees per month and you manage to rent it out for the same amount. Thus, the annual expected rent and the actual rent received both are 120,000 rupees. Moving forward, we deduct the property tax paid to the local authorities from this GAV. Suppose you paid property taxes amounting to 10,000 rupees for the year. Subtracting this from your gross annual value, the net annual value, NAV, of your property becomes 110,000 rupees. Next, we apply the standard deduction, which is 30% of the net annual value. This deduction accounts for the expenses related to the maintenance of the property. 30% of 110,000 rupees is 33,000 rupees. Deducting this from the NAV, we get 77,000 rupees as the net taxable income from the property. However, if you have a home loan on this property, the interest paid on the loan can also be deducted. Let's assume you paid an interest of 20,000 rupees during the year on your home loan. Deducting this, the income from the house property that is subject to tax now stands at 57,000 rupees. Remember, if your net result is a loss, you might be able to set this off against other income heads depending on prevailing regulations, which can further affect your tax liabilities. With these calculations, you can determine how much tax you should be prepared to pay. As we wrap up, let's summarize the key points to remember about income from house property. First, understanding what qualifies as income from house property is crucial. It involves the revenue earned from a property, which can be a building or land appurtenant thereto, owned by the taxpayer. The essence of this income category lies not in the ownership of the property per se, but in the capacity of the property to generate income. The conditions for taxability highlight that the property must be owned by the taxpayer. and it should not be used for business or professional purposes. The property can be charged to tax on a real or notional basis, depending on whether it is rented out or self-occupied. Moving to exemptions and deductions, which play a pivotal role in determining the taxable amount. Deductions such as the standard deduction of 30%, interest on borrowed capital, and pre-construction interest can significantly reduce the tax burden. It is essential to be meticulous in claiming these deductions to optimize tax liability. Calculating the income from house property requires attention to detail. The gross annual value needs to be determined first, followed by the deduction of municipal taxes. After applying the standard deduction and interest on borrowed capital, what results is the net annual value, which is subject to tax. It's imperative to ensure accuracy in these calculations to avoid both under- and overpayment of taxes. Accurate calculation not only complies with the law, but also secures financial health by preventing unnecessary tax payments. You, my dear friends, for joining me today. Remember, understanding your taxes can lead to wiser financial decisions.